You know, Usually when we evaluate a commercial investment, there's this deeply ingrained expectation of permanence.
Right, like a cornerstone. You buy a commercial building, you sign a 10-year lease, you bolt your illuminated sign to the masonry, and you can literally point to the physical structure and say, well, there's my business.
Exactly. It's tangible. But then you step into the modern franchise landscape, specifically the niche service sector, and suddenly that brick-and-mortar anchor is just gone. Today, we are analyzing the CORTZ franchise opportunity.
Which is a fascinating pivot from traditional models. CORTZ is a mobile, year-round business specializing in the construction, resurfacing, repair, and maintenance of game courts. So we're talking pickleball, tennis, basketball, and padel.
Let's start with the appeal of that asset-light model, because I think we have to understand the psychology of the modern franchise buyer. We're often talking about a corporate professional looking to exit their W-2 job, right?
Yeah, or an existing owner looking to diversify.
Exactly. And for them, speed to market and liquidity are paramount. With CORTZ, we are looking at a total investment range of roughly $100,000 to $200,000, with a liquid cash requirement of just $25,000.
Which is undeniably low for a franchise operating in the commercial space.
I'll give you that. It's remarkably low. And the reason it's low is the mechanism of the business itself. By utilizing a branded CORTZ service truck, you completely eliminate the capital expenditure of storefront.
You're bypassing real estate entirely.
Right. Think about what you avoid. You don't have a 9-month build-out phase. You don't have to navigate zoning boards for a retail location. You aren't trapped in a triple net lease. I actually view the CORTZ truck model as, like, infrastructure as a service.
Okay. Infrastructure as a service, that's a clever framing.
Well, it's accurate. Instead of waiting for foot traffic to come to your zip code, you are mobilizing your capital. You take the service directly to the customer, whether that's an outdoor municipal park in the summer or an indoor commercial gym in the winter.
Okay, so the capital deployment argument makes sense. Turning a static expense into a dynamic, deployable asset is a great theory. But let's talk about the defensive moat, or really the lack of one.
You don't think there's a moat?
I think it's highly questionable. In franchise economics, your moat is what protects your territory from competitors. If the barrier to entry for this entire business is essentially a Chevy Silverado and access to some specialized acrylic paint, how does a franchisee protect their market share?
From who, exactly?
From independent, non-franchise contractors. The classic guy with the truck problem. Bob's paint truck, right? An independent contractor can buy a van, print a logo, and offer to paint a local pickleball court for 20% less.
Because Bob isn't paying a franchise fee.
Exactly. Bob isn't paying franchise fees or ongoing royalties. Brick and mortar, while expensive, creates a physical community anchor. It establishes institutional trust.
I disagree that you need a building for trust.
But when you are selling B2B, say, pitching a city council to resurface 12 public parks, a branded truck driving past City Hall struggles to replicate the established presence of a physical headquarters. Why wouldn't the city just hire the cheaper local guy?
Because the city council isn't buying paint. They're buying risk mitigation. Let's unpack the psychology of municipal budgeting and B2B sales here.
Go ahead.
If a city hires Bob and his acrylic mix peels in 6 months because he didn't properly cure the asphalt underneath, the mayor looks terrible. The parks director gets fired. They want an insured, bonded, national brand with standardized procedures. The moat isn't the truck.
Then what is it?
The moat is the professionalization of a highly fragmented industry.
Okay, but how does the franchisor actually deliver that professionalization? I mean, structurally.
Through proprietary systems like Fran tools. The source material highlights this software suite specifically. It's not just a digital Rolodex, you know. Fran tools centralizes the entire operation. It manages automated B2B invoicing, optimized routing for the mobile crews.
Right.
And most importantly, it professionalizes the quoting process. When a CORTZ franchisee walks into a commercial gym, they aren't handing over a handwritten estimate on a clipboard. They are providing a standardized, data-driven proposal.
Which is a standard franchise benefit, sure.
But the source material emphasizes their commercial messaging specifically. Phrases like recapture your market and reclaim your revenue. They teach the franchisee to sell the ROI of the court, not just the physical resurfacing.
That is a highly sophisticated B2B pitch. I don't disagree with the marketing angle, but look, we have to look at what is actually driving the demand for those quotes.
You mean the market growth?
I mean, the entire thesis of this franchise relies heavily on the pickleball boom.
I wouldn't call it just the boom. It's a structural shift in recreational infrastructure. The USA Pickleball Places to Play data, which is in the material, shows it has been the fastest growing sport in America for 3 consecutive years.
Which is a great stat.
We are seeing 130 new locations opening every single month. That is 130 new physical assets being poured into the ground every 30 days.
And that data is impressive. But my concern is the fervor behind it. Let's look at the exact language in the franchisor's own materials. They literally use the phrase, jump on the pickleball craze.
It's marketing copy.
And under their paddle court section, they write, join the paddle frenzy that is heading this way fast. Craze, frenzy, these are their words, not mine. They are explicitly targeting a hyper-emotional, trend-driven market psychology.
I think you have to separate consumer marketing from the physical reality of the product. The demand is real.
But the psychology matters for an investor. Are franchisees buying into a durable, decades-long business system, or are they simply purchasing a temporary license to ride a cultural wave?
A wave that will normalize, you mean?
Yes. When the frenzy cools down and municipal budgets tighten, is a city really going to prioritize resurfacing a pickleball court every 2 years?
They have to, because of the physical chemistry of the courts. This isn't a fashion trend where people just stop wearing a certain brand of sneakers. This is physical infrastructure exposed to the elements.
Right. It's outdoors. Mostly.
Let's talk about how these courts actually degrade. You have UV radiation from the sun constantly breaking down the polymer bonds in the acrylic surface. You have the friction of athletic shoes acting like sandpaper thousands of times a day.
Plus weather changes.
Exactly. You have thermal expansion and contraction of the underlying asphalt causing microfissures. A high-traffic court physically degrades and becomes a safety hazard, a slip-and-fall liability in roughly 2 to 3 years.
So you're arguing the degradation creates an unavoidable maintenance loop.
Exactly. It's a recurring revenue engine. Those 130 new locations opening every month, that is a compounding annuity of future residual business.
Assuming the locations stay open.
Even if some close, the volume is massive. In 24 to 36 months, every single one of those new courts will need professional resurfacing, patching, or complete reconstruction. And importantly, CORTZ diversifies beyond pickleball.
Tennis and basketball.
Yes, legacy sports with permanent footprints in literally every town in America. If the padel frenzy normalizes, the franchisee is still fully equipped to revive a high school tennis court or university basketball facility.
All right, I concede the physical reality of court maintenance. The demand for the service exists. But my deepest skepticism isn't about the courts. It's about the corporate entity standing behind the franchisor.
The franchisor itself.
Yes. Let's ground this discussion in the stark reality of the franchisor's current maturity. You mentioned earlier that buyers want to avoid the risks of commercial real estate. But what about the risks of a nascent franchisor?
Well, the unit economics actually reward that early entry. Let's look at the royalty structure, because it's mathematically designed to incentivize multi-unit scaling.
Okay, let's look at it.
The royalty is 6% on the first $1 million in revenue, and then it drops to 4% on additional revenue. For an investor, that sliding scale actively rewards you for capturing more territory and pushing higher volume.
Assuming you hit that volume.
Right. But when you pair a sliding royalty with that low $25,000 cash entry point, you have a very clear pathway of multi-unit empire building. You can take the cash flow from truck number 1, roll it directly into truck number 2, and expand.
Expand your territory without needing a $500,000 SBA loan?
Sure, but an empire built on what foundation exactly?
The franchisor systems. We need to look at the numbers in the NFA source material. Franchise inception, 2024. Active units, 1. Corporate headquarters staff in Auburn, California, 2 employees.
Every brand starts somewhere.
2 employees. You are talking about building a multi-unit empire on a foundation that was literally poured yesterday.
I look at that as an opportunity for prime territory.
But at what cost? How can an investor accurately model unit economics when there is virtually no historical performance data across different geographies or economic cycles?
The Item 7 outlines the initial investment clearly.
But a sophisticated franchise buyer pays royalty specifically for a proven, de-risked system. They are paying for a playbook that has survived supply chain disruptions, labor shortages, and recessions.
Which takes decades to prove.
Exactly. When you buy into a system with one active unit and a two-person corporate staff, you are not buying a proven playbook. You are a beta tester.
Come on, I think beta tester is a pretty cynical framing. I'd call it being an early adopter.
Well, cynical or just mathematically accurate?
In the franchise industry, early adopters secure the absolute best territories. If you wait until a brand is 500 units and a massive corporate campus, you aren't going to get the prime commercial districts in Dallas or Atlanta or Austin.
Those will be locked up.
Exactly. The trade-off for limited historical data is prime territorial availability.
Prime territory doesn't matter if the corporate infrastructure can't support your operations. 2 employees at headquarters means that if you run into a complex operational issue, let's say a massive global supply chain delay on those specialized acrylic polymers you mentioned.
Or a zoning dispute.
Right, a complex zoning dispute regarding a commercial paddle stadium. You do not have a deep bench of corporate experts to call upon. You have the founders, and founders are passionate, but their bandwidth is severely limited.
They are building the team, though.
But right now, you are taking on venture capital levels of risk, but you are capping your upside within a franchise royalty structure.
I understand the concern about corporate bandwidth, but I think you are vastly overestimating the operational complexity of the business model itself.
How so? It's commercial construction.
But it isn't a quick-service restaurant. You don't have perishable food inventory that can spoil. You don't have surprise health department inspections. You aren't managing a staff of 40 minimum wage employees with 100% annual turnover.
True, the labor model is leaner.
It's a highly targeted B2B and B2C service model. You assess the physical court, you prep the surface, you apply the materials, you paint the lines. The operational friction is inherently low, which mitigates the risk of a small corporate headquarters.
So you're saying they don't need a huge team?
Exactly. Those 2 people in Auburn don't need to help you manage complex retail merchandising or rotating seasonal menus. They just need to support the lead generation framework and the software systems.
But lead generation is the entire ballgame. If you don't have a physical retail location driving organic, drive-by awareness, and you only have 2 people at HQ, who is actually driving the complex B2B sales?
The franchisee drives the local sales.
We talked about municipalities. B2B sales in that sector require long, complex cycles. Convincing a city council to grant you the contract for their public parks involves navigating bureaucratic red tape, managing the RFP process, dealing with budget committees.
Yes, the RFP process is demanding.
A branded truck driving past the mayor's office does not win you an RFP. An established, robust corporate sales support team does. I struggle to see how a 2-person headquarters can provide the localized, high-level B2B sales support necessary to actually execute that strategy.
The franchisor provides the framework. The franchisee executes the sale. That is the fundamental nature of business ownership.
But we have to be honest about where the burden of execution falls. It falls entirely on an owner who is likely operating out of a small industrial park or even their home office.
Which keeps overhead low.
Yes, but they are trying to convince major facilities to trust a brand with a track record that literally began in 2024. I am not saying the market demand isn't there.
The demand is undeniably there.
As we agreed, the sheer volume of CORTZ being built right now is massive. And the chemistry of degradation guarantees they will need repair. But I am fundamentally questioning the vehicle being used to capture that market.
The specific franchise vehicle.
Yes. A corporate professional evaluating this needs to understand that they aren't just buying a passive investment. They are buying a demanding job in localized sales and operational management attached to a highly speculative infant brand.
I think it really comes down to how an investor weighs agility against history. Yes, the brand is young, but the CORTZ model offers a highly scalable, low-barrier entry into a market that is exploding.
It definitely offers agility.
It is perfectly structured for investors who want the agility of a mobile service and the financial beauty of recurring revenue without the heavy anchor of commercial real estate. Service offering across pickleball, tennis, basketball, and paddle ensures that even if one specific sport cools off, the underlying business of infrastructure maintenance remains entirely viable. The sheer volume of new sports courts being constructed across the country represents a massive opportunity.
Oh, absolutely. Someone is going to have to maintain, repair, and resurface those millions of square feet of acrylic and asphalt over the next decade.
The physical demand for court maintenance is a certainty.
It is. The divergence in our view is simply whether this specific franchisor, at this exact moment in its life cycle, with its current corporate structure, is the most prudent way for an investor to capitalize on that demand.
Which really reflects the broader philosophy of franchise investing, doesn't it? Evaluating a business opportunity always requires balancing the allure of a booming market against the rigorous scrutiny of franchisor infrastructure.
And historical performance. It's a delicate equation.
It really is. Evaluating an infant franchisor requires a completely different analytical toolkit than evaluating a 50-year-old heritage brand. You need professional guidance to ground yourself before jumping in.
Which is exactly why you shouldn't go it alone.
Right. In fact, if you're thinking about franchise ownership, you want to avoid costly mistakes, right? It's to speak with an experienced franchise advisor.
Because the landscape is constantly shifting. The days when an investment was strictly measured by the square footage of a resale space and the foot traffic on a specific corner are evolving rapidly.
Exactly. The modern investment landscape might not always offer the comfort of a brick-and-mortar anchor anymore. But whether you choose to build a deep, heavy foundation or put your capital on wheels and chase the horizon, you have to make sure you know exactly what ground you're driving on.